I'm looking at a weekly chart for the euro, and I probably should shift this chart to the right a little bit. Yeah, it's in on this weekly chart, and you can see this low here that we actually the low of this current weekly candle happens to be the low of the day, low of 2 days, today being Wednesday. And you can see that low below the lows established over much this year at or just below 130, the psychological level. Let me put a line at one of the lowermost lows established in February, around 29.80. We're below that now. So really the lowest point, let's go to the daily chart now. We'll give you some different perspective on this. We've hit the lowest point today on the euro that we've seen since January 23rd. Now, what has led the euro to this point? Why has the euro dropped, well, not just today, but really this week? We had a brief update on Monday after the gap established between Friday's low and Monday's Asian session open. But it's been down ever since. One, if you look at the charts here, we've got a series of lower highs working here, which I can identify with some reddish arrows. There you go, series of lower highs. So, a question that might, there's a bunch of different questions circling on my mind right now, so I don't know where to start. Let's start with this. I'm going to start with a question I'm sure many of you have been pondering. How has the euro held up so long? Is anyone else wondering that? How has the euro managed to hold up for so long above that horizontal blue line, or more generally speaking, above, let's put another line at 130, because that's really the key area per se there. I'll make this a black line at 1.30. Surely I'm not the only one pondering that. In fact, I know I'm not. I'm just wondering if I'm the only one in here pondering that. Oops, I'm just going to make that black. Why is the euro held up above 1.30 for so long? I mean, things have been pretty nasty in Europe, and increasingly so lately. Any thoughts on that? Believe me, I've got a few thoughts on it, but I wanted to see how smart some of you are. And I know there's enough participants in here that I bet the one or two have a theory, and probably a very good one. And by the way, any theory that any of you espouse or anything that I mention, it's largely speculation as to what's really holding up or what really drives at any time or over any period of time any currency or currency pair. Yeah, Gam, you hit the nail on the head for me when it comes to a lot of price action in the currency market. It's all relative. It's all relative. Yeah, hardly mentions media propaganda. Yeah, Spin Doctor hits one that I especially wanted to emphasize. Well, Gam mentions two. QE3. What does that mean? Many of you know what it means, but for those who don't, that's another so-called quantitative easing program. The Federal Reserve, the U.S. Central Bank, has pursued two major programs, and I guess you would call the current Operation Twist a relatively minor one. Two major programs pursued by the Federal Reserve. The first starting in late 2008 after the bankruptcy of Lehman Brothers. The second one starting in November of 2010, I believe it was. That's QE2 program. So-called QE2 program was hinted at by Ben Bernanke in a speech at Jackson Hole, Wyoming, in late August of 2010, that same year. What these programs have, what the Fed has looked to accomplish for those programs, they've done things like buy U.S. Treasury securities, in other words, buy U.S. government bonds, and especially in the first program, they bought some mortgage-backed securities to support the U.S. housing market. A simple way to put it, it's not the only way. Well, actually, I'll be able to put it in a couple of different ways. Because I want to make a second point, because it's relative to what we're seeing in the equity markets. One thing the Fed wanted to do, as I see it, was keep longer-term rates lower. By lowering longer-term rates, for example, you do support, among other things, the housing market. Some of you may have noticed that mortgage rates, U.S. mortgage rates, in other words, loans for buying a home in the U.S., are based on, at least in part, on longer-term Treasury yields. And as the Fed buys Treasury securities, especially mostly from the major U.S. banks, that support for U.S. Treasury prices means yields go down. As yields goes down, you tend to see a drop in U.S. mortgage rates. Lower U.S. mortgage rates makes mortgages cheaper, or housing or monthly payments for home buyers lower, and then makes it more affordable for more people, hopefully, to buy homes. Now, there's a lot more to the housing market, a lot more headwinds in the housing market other than that, but that's one thing that the Fed's moves were intended to do, is to support the housing market. And also it makes actually a lot of borrowing rates lower. Makes it cheaper to borrow all kinds of different money, whether you're an individual consumer or a corporate, a company. So there's that. The Fed, as it often is, looks to stimulate the economy by lowering different kinds of rates. The Fed had already, through late 2008, after the Lehman Brothers bankruptcy, taking its classic monetary policy tool, the Fed funds rate, down to virtually zero interest rate policy or reserve. The current range established in late 2008 and in December of that year was to take the Fed funds rate between 0 and 0.25%. So once the Fed did that, then the next question was, what else could they do? Well, the Fed took down essentially brought shorter-term rates low at the end of 2008, but with these quantitative easing programs, they brought down longer-term rates, which again are the basis for several different types of the rates for several different types of loans. Again, an effort to help stimulate the U.S. economy. Another thing the Fed has done is to, with these quantitative easing programs, is to essentially drive investors into riskier assets. If you look at, especially today, if you look at the yields on some of these longer-term Treasury securities, there's not a lot of appeal, at least certainly not nearly as much appeal in buying the longer-term Treasury securities. The yield isn't there. The return isn't there. Prices near historic lows, prices near historic highs, yields near historic lows. So in order to garner a return, investors are driven more and more into something which would yield a greater return, and that something has become more commonly equities. And by driving investors into more and more investors in equities, the hope is that the Fed, at least one of the hopes of the Fed, as I see it, is to create a so-called wealth effect. As equity prices drive higher, those with investments, even if it's only in their retirement accounts, those with investments in equities will feel wealthier, and those who feel wealthier tend to act accordingly, whether it's invest in new business or spend more money as an average consumer, whatever. Now, the effect of that in this environment is debatable, but I'm just stating what's the intent, or what's the hope, if you will, of the Federal Reserve in doing what it's been doing. So let's bring those home. So that this describes some of the intentions, or at least maybe some of the hopes behind the Federal Reserve in its prior quantitative easing programs. In terms of movement in currency prices, it usually goes like this. I'd say usually for a raising. It doesn't always go like this, but usually goes like this. When a central bank does something to in the direction of a type of accommodative policy, a type of easing policy, an example of that is lowering rates. A more common recent example is more quantitative easing programs, buying government bonds or buying other types of assets, like for example the Bank of Japan has done recently. When a central bank does something in that direction to stimulate an economy, it's usually a negative for that respective nation's currency. So again, one thing that seems to have given some recent support to the Euro USD is the idea that the Fed is still of a mindset to unleash another round of quantitative easing if conditions dictate it.